Good morning, good afternoon, and good evening, everybody. Hey, welcome to this episode of the Note Closure Show. As always, Scott Carson, jacked up you here today. We're going to get into what I think is going to happen in real estate here in the future. I'm going to put on my Swami hat or pull up my glass ball and look into the future and tell you what I think is going to happen in the next 12, 24, and 36 months. But first, before that, today is magical episode number 900. Wow. Come a long way since we started doing these as Facebook Lives back in the day. It's hard to believe it's been, 8 years now since we really had the show. And I'm just blown away that we've made it to 900. We've still got a long way to go. We've come a long way. We've seen a lot of crazy stuff. We've had some great guests on. We've had some great content. And first of all, thank you for making us the number one podcast for note investors. Over 1 million plus downloads. And just we'll keep showing up as long as you keep listening, ladies and gentlemen. So once again, thank you. As always, if you're interested, check out our free one-day class at noteweekend.com. That's my gift to you to dive into the note space. But let's get into what I think is going to happen. Now, it's a crazy, chaotic world out there. Let's just face it. You've got commercial defaults increasing every month. We're at 9.1% of all commercial assets. Commercial notes are in default. Not good. It's higher than others. You have cities that are at 24% in default, like Charlotte, down to cities like Tampa that are pretty good at 2%. You've got chaos going on with illegal immigrants in El Paso, in Aurora, in Dallas. You got freaking crazy illegal aliens eating dogs and cats in the street. Okay. I don't know who's going to win the election, whether it's going to be Kamala or Donald. Here's what I do know. If you spend more time focused on who's running and what Donald said or what Kamala said or what they didn't say or what they lied about, then you're part of the problem. I don't care who wins. Each has different issues and each will have different issues to deal with. And if you're a real estate investor, I'm going to tell you right now, it's going to pay to be the bank. It's going to pay to be the note investor more so than it is going to be to owning real estate out there. All right. As a note investor, we're seeing deals 6 to 12 months ahead of things. We're able to work things out by buying the debt at a big discount and then either working it out with the homeowner or the borrower, property owner, and then either taking the asset back in management or foreclosing and going that route. Here's what I think is going to happen in the next couple of years. First and foremost, let's talk about Florida. South Florida is a good example. What's going on in Florida right now? It's not commercial real estate, it's the condo apocalypse. With the new law that they have in place that if a condo, high rise or condo is 30 years old, then it's got the reserves have got to be funded so they can do all these special upgrades to avoid another sunrise catastrophe. But they're making everybody get fully funded by the end of the year. And it's really going to hurt a lot of people. Already it's hurt a lot of people with special assessments and condo association fees going up by 40, 50, 60%. Assessment fees in the six figures for some people. Condos being at an all-time high as far as numbers of condos on the market. It's over 20,000 listings. It's not a good time. If I was a condo owner in South Florida, I would be very worried. If I ever wanted to sell it, I probably am not going to be able to sell it anytime soon. Values are dropping. Foreclosures are going to increase. You're probably going to have whole buildings that are basically vacant because people cannot afford the assessments. Now, the newer ones, okay, may not be that bad. But there's almost 1 million condos out there that are basically going to be obsolete, unfixable, not worth it, not worth the brick they're on because it's going to cost too much. Yes, salt water and steel or rebar do not make a good combination. We can all agree to that. So I'm a big believer that you're going to see condos at 5 and 10 grand, like we saw them back in 2008, 9, and 10. Yes, I could buy condos by buying the debt for 5 grand, 10 grand back in the day on A1A. Okay. I bought some. I should have bought a whole lot more. I don't think they're going to be a deal at 5 grand because you're going to still have special assessments and back taxes and HOA fees. And a good thing they have safe harbor that if you buy the debt, you can wipe out the condo fees. That might make the only sense where banks go in or lenders go in like us and buy condos up at a fraction of what's owed and then turn it and operate it. But you're going to have to put some money into it to get these up to date. Otherwise, they're just going to be vacant and unfinanceable. You won't be able to sell them to anybody. Maybe they'll turn them into an apartment complex. Who knows? But then you're still going to be responsible for the repair. So the only way it makes sense is to buy these at dirt cheap. I mean, really dirt cheap. Fix them up, upgrade them, look at what's going to be needed, and either operate them that way or just tear them down and build something else up. But it's going to be a hurting in South Florida for a while, and I would just avoid it like the plague. Not only is insurance costs killing it, but storms, it's just a bad place. Okay. Commercial, I think we're going to see. We haven't seen rock bottom yet. Some cities are being hit harder than others, and it depends on what's going on in each market with office, retail. A lot of places are being hurt. Some areas are doing well, okay, but the ones that are hit the most, we'll do an episode. I think the next episode we'll do is on the top 10 markets that are being hit the most with commercial distress. Will be good. But we're still got a ways to go. There's still a gap between what banks want to sell the debt at. There's still issues with a lot of this commercial debt. These borrowers that have properties, they over-purchased or they over-financed or they over-leveraged. There's been a lot of investors in the private equity side have been wiped out from foreclosures. We're going to see more of that. All right. You're going to see a lot more stuff get wiped out because of foreclosures, and investors are losing millions, if not billions of dollars in the private equity space that invested, that funded the mezzanine or the difference between what the bank would finance and what these assets were selling for. So if you're in one of those deals, just try to hang around, try to work out something, get something if you can, and realize it's investing, not guaranteed. That's the thing. As investors, you have some good deals and some bad deals. I think there'll be a lot of people that are going to be, taking it on the chin, get knocked down. It's all up to you to get back up. So commercial real estate in different areas is going to be better. Others is going to be downright worse. I think one thing that we have to keep in mind is I think the immigration policies of this country, of the open door policy that the Biden administration has had, let's face it, it got worse in the last 4 years. There's no doubts about it. If you look at, we've had Democratic rule basically 12 of the last 16 years. Okay. You can't blame it on Trump's 4 years. You can't do that. When you let in 15 to 20 million illegal immigrants into the country, you're going to have issues. The biggest issues are going to be in the sanctuary cities. That's what we've seen happen in Aurora, Colorado, where it's now 3 or 4 apartment complexes that the Venezuelan gangs have taken over. El Paso, Texas. New York is having issues. If I was a real estate investor, I would be looking for distressed assets in those areas like hotels, apartment complexes, and working to fix those up. And then the way to make money is Section 8 them or see if there's any incentives by the local government to house these individuals. But you got to be damn sure that there's not gangs among them. That requires on 24-hour day security, police presence. That kind of stuff is very, very important. Not having some part-time rent-a-cop there. You need to have a police presence to make this happen, and you need to be very selective on who you let into these places. I understand some people would call that racism, discrimination. Go ahead and call me that then. I think there's bad people amongst every race, white, black, Mexican, Venezuelan, Chinese. It does not matter. Okay. We're going to continue to see land prices rise like they have here in Texas, double, tripled in the last few years. Whenever you're near a city, that's the path of progress. You're going to ultimately see land costs continue to go up. It's going to continue to get cost more to build something. Interest rates may go down, but I do not believe we're going to see this huge rush of people looking to buy. You still have a lot of people that don't want to sell because they don't want to move into something that's half the price for twice the amount of interest rate, if you know what I'm saying. If they're in a 2.5%, 3% mortgage, selling off and getting into something that's 6% just doesn't make a lot of economical sense. And I think that what's going to have to happen is some major changes in how you buy a house, how you finance a house. One of the first things I believe is going to happen is you're going to see the emergence of the 40-year mortgage or the 50-year mortgage on a more commonplace, not just where it is now on an FHA refinance for a forbearance agreement, a mod workout. I honestly believe in the next 12 to 24 months that Fannie, Freddie are going to embrace that and roll that out like a 30-year mortgage. It's going to be an option for you. Well, how does that work? Well, it makes homes a little bit more affordable on a monthly budget basis. With appreciation and prices going up, it's not that big a difference in the interest aspect of things. Yeah, you pay a little bit more interest, but most people aren't in their houses for 30 to 40 years these days. They're selling off. And so I think you can see that maybe not on a jumbo loan basis, but probably the sub-jumbo, sub $500,000 mark you're going to see a 40-year mortgage be able to as an option for folks to buy. I don't think that the policies like California has enacted with the $150,000 or $200,000 down payment assistance to anybody is going to be utilized efficiently. I mean, heck, the government over there in California can't tell you where they spent $2 billion on the homeless anyway right now. And I think if you look at cities like, or not just cities, let's just go down, right, say states. Let's just go to states of California, Washington, Oregon are going to become third world countries. That's the way I look at it. When you look at how they enact, how they are more tenant friendly, not investor or lender friendly. Those are the people that are moving out. They're taking their dollars and investment money, moving it somewhere. You're probably going to run into anything that has rent controlled will become a slum. And that's what's happening in parts of New York right now. New York City, rent controlled units doesn't mean the taxes and the insurance goes down or stays the same. Those things continue to go up. And so the profit margins or the ability to even turn a profit or to break even are becoming harder and harder to do, especially when these buildings need to be updated. So I think you're going to see a lot of issues. I think New York City's already seeing that with Mayor Adams trying to get people to move out, the immigrants to move out, the hotels to move out, incentivizing them $4,000 a head to get the heck out of Dodge and go somewhere. Those areas are rough. I know people that lived in the city for years, loved the Big Apple, but cannot stand that. And they moved the heck out of Dodge to go somewhere else that was more friendly, cheaper, and didn't deal with the issues of crime and gang and just utter disgust and ugliness on the cities when it comes to trash and lack of care that a lot of these immigrants are doing. Look, I get it. They need a place to go. We need to take care of our country here first, is my biggest belief. Take care of the United States first before we start helping everybody else out in the country. In the world, yes, it's good to have an immigration plan, but right now we need to shut our borders. We need to fix what we've let in and kick out the riffraff, deport the criminals, deport the gangsters, and work to make America great again. Whether it's a Democratic leadership or Republican leadership, we've got to take care of here. Trying to make everybody happy is going to solve nothing and cause us all to flush down the toilet. That's my opinion. That and $5 might get you a half a cup of coffee at Starbucks. I also do believe that if you're a loan officer or a real estate agent, I think your days are numbered. We've seen a huge amount of realtors leave the industry, a huge amount of loan officers leave the last few years. Yes, it comes and goes in waves, but with the way that AI works, artificial intelligence works, and how it's affecting the mortgage industry and streamlining underwriting, streamlining qualifications, and the ability for all of us, basically, if you've got a credit score, be able to see exactly what's going on. I think AI is going to replace a lot of those loan officers. You're going to qualify for specific programs. I don't think it's going to stop people from getting owner finance. I think owner financing is going to play its critical part like it always does. But if you're trying to buy and go a traditional loan, I don't think you're going to find a lot of luck as a loan officer making money. They're going to squeeze that for profits, quit paying commissions in a lot of cases. And then the same thing is going to happen on the realtor side. You're going to have some realtors that are there listing things, specific asset classes. But I think if you're buying in a major city or you're buying a lot of these iBuyers, there's no need to have a realtor. Either you qualify and you can pass through, go check your house. Once you qualify, you may get a pass to a house, go take a look at it. But I think that's going to do away with a lot of realtors. There are already a lot of realtors leaving the industry. It's unfortunate. I think people need to put money away. I think things will get more expensive if we see price fixing, things like that. It's going to make things even more pricier. We've got to do something to bring down cost of goods, cost of groceries. There's a lot of people hurting. Already seeing a huge amount of defaults on the RV, auto loan, credit card debt. That's only going to get worse and worse in the situation when it comes to home buying and people trying to be able to afford things. I hate to say this, but I think we're going to see an increase in parts of the country where companies go in and buy up. I don't say just hedge funds, but I think companies are going to go in and buy up, build houses, and then turn it into a rental aspect. I think we've kind of made that cusp where it's cheaper to rent in most markets than it is to buy. We've got to do something to curb that. Otherwise, we're going to all be like Memphis, Tennessee, where it's an 85% rental market. You're going to see a lot more people doing like what they do over in Europe and London and stuff like that, where you have homes being one home turned into two homes, or you have multiple generations living in a household. It just is what it is. When housing is so unaffordable, people have to pair up. They're not having a whole house themselves. They may have a bedroom themselves. So I do believe that we as investors will have plenty of opportunity. I think it's going to make sense, more so on the note investing side of things, to buy bigger discounts. I hope they don't adjust things and on that side to make it difficult to buy debt. Who knows? They could very easily pass a law, make you required to have a bond or require you to be a bank or something like that, where you can buy the debts of individual investors. If that happens, who knows what's going to, if that is enacted, who knows what's going to happen? More licenses, you may get people bonding together to create a note investing company, note buyers company. That would be something I would see happen, more so. I just think that there's going to be a lot more distressed commercial debt hitting the markets next 12 or 24 months. Some asset classes like office are basically going to have a hard time rebounding for a while, depending on what's going on in the city and the saturation of that asset class. There's just a lot of people hurting out there, a lot of banks hurting. I think we're going to see starting next year, maybe not banks going out of business, but banks getting bought up, especially a lot of those banks that have unrealized losses from bad investments during low interest rates. Those that have a huge amount of negative ratios when it comes to the commercial paper versus the assets that they have, and unsecured deposits or uninsured deposits, where they're way upside down on that. I think you're going to see banks merging. Some of the bigger banks gobbling up the smaller guys, and we're going to see a bit of a tightening there on the banking side as some of these banks that have popped up the last few years are getting gobbled up, and going from there. So that's my thoughts. Maybe it's not all rosy. I think there's plenty of deals, plenty of opportunities if you know how to dive into this, if you know how to raise capital, if you know how to market. That's the biggest thing. If you don't know how to market, you're going to be hurting. You've got to spend just as much time on your marketing side in helping you raise capital and helping you find deals versus just the nuts and bolts and the A to Z of the ins and outs of specific real estate. It's all about marketing, more so than anything else that has ever been in the world these days. How you use social media, how you market your business, how you market yourself is one of the biggest things that you'll need to do. If you've been through a bad thing, guess what? It's a lot of bad things have happened to good people. It doesn't make you a bad person. I've got some of my good friends who've gone through issues in the past. Guess what? They're going to dust themselves off, pick themselves up, and get back into the game, because there's plenty of opportunities. And that's the great thing about this country. You can still fail and pick yourself up and go at it again. So I encourage you to listen to this podcast. If you like it, share it with somebody, share it with one person. Those are my guesses at what's going to happen. That's what I think is going to happen. Like, I'll quick recap. I think real estate agents, loan officers are going to be wiped out by AI most of the time. I think for homes to be more affordable, they're going to have to introduce 40 and 50-year mortgages, at least for first-time home buyer programs. I don't think there'll be a huge amount of buyers flocking to the markets as interest rates drop down some. I just don't think that's going to happen. Commercial real estate is going to be probably the worst we've seen in the next 12 to 24 months. Florida is going to be a desolate town. West Coast will be a desolate town because of the bad policies towards crime, letting just people steal shit for free. Does not work. Your sanctuary cities are the cities I would get the hell out of Dodge. I would get the hell out of a sanctuary city and move somewhere where you are not at risk of being robbed, shot, raped, your stuff stolen, and nobody's there to help. And I almost put Austin, Texas in that class. Who would have ever thought that? But Austin is a very liberal, and the city council has really kind of enacted laws here in Texas, in Austin, that just don't make sense compared to the rest of the state. So guys and girls, once again, thank you for listening to episode 900. Thank you for helping to make us, once again, the #1 podcast and the #1 YouTube channel for note investors. And we plan on cranking out another 900 episodes. We'll be excited when we hit that 1,000 episode mark sometime, probably in the first quarter of 2024. We'll have a celebration for that. And we really look forward to all of you that listen. Thank you so much. Thank you for your comments. Thank you for your 5-star reviews. Thank you for following. And to all our haters out there, thank you as well. You keep me motivated. You keep me driving. Thank you for listening, because when you tell me I can't do something, I'll show you that I can. And it's a very special thank you to you. A big shout out goes to Stephanie Goodman, not a hater, but #1 supporter. Absolutely my biggest cheerleader, biggest fan, for being from the very get-go here and promoting me and kicking my butt to get started. Big shout out to some of the fans along the way, the Tom Hazards, the Tracy Hazards, the Aaron Youngs, Michelle Youngs from Laughlin Associates, the Greg Reeds from Secret Knock, Val Satir, Joel Markovitz, just to name a few, the Jason Bible out of Houston, some of my amazing friends, the Chris Prefontaine, your team, George Anton from Finance, and all of our other friends. I know I'm forgetting a few folks out there, but thank you so much for being supportive of Merrill Chandler, Get Fundable, Jessica DeBoer, I can't forget you. Thank you so much for being a part of the show, past sponsors, and some of our biggest advocates. Let's all go out. Let's take advantage of what we know and apply this knowledge in a way that we can make the next few years even more profitable by being a note investor. Because it's all about knowledge, ladies and gentlemen. If you know things are going up and going down, there's most amount of money is made when there's blood in the water. So learning how to take those things when everybody's running scared the sky's falling, that's the time to make hay. So go out, take some action, everybody, and we will see you at the top. Thanks for listening, everybody.